and then you'll count me when I start, right?
Yeah.
Good morning. Welcome to the BYU Marriott Real Estate Webinar Series. My name is Barrett Slade, Professor of Finance, and the host of today's webinar. Before I introduce our guest, I'd like to announce that on November 17th, Dan Eskich, a senior research fellow at the Kim C. Gardner Policy Institute, will give us an update on the Utah housing market. Should be excellent. We'll be sending out an invitation to that webinar in the coming days. If you have questions for today's guests, please click on the Q&A button at the bottom of your screen and type those in, and we'll get to those as time permits. So today we have with us Mr. Jared Giles, a member of Green Street's strategic research team. Jared holds a CFA designation and is a graduate of the finance program at BYU, as well as a former student. So it's great to have him with us today. Jared, welcome. It's so good to see you, and we look forward to learning from you and hearing your presentation. So take it away.
Thanks. It's great to be here, Barrett. Thanks for the invitation. I'm going to pull my screen up here. All right. Well, a little bit about Green Street for those of you who aren't aware. So Green Street, we are a real estate research data and now news firm. Traditionally, we've been focused more on the public market. So that's where Green Street had its roots. We were originally stock pickers, so think buy, hold, sell recommendations on publicly traded REITs. And over the time and through the years, we've broadened out to be more of a commercial real estate research firm that focuses both on the public and the private market. And we also have a new news business where we incorporate all of those insights to make interesting insights for all commercial real estate participants. And the kind of a little overview of what I want to cover today is cover a little bit about what has happened so far year to date in the private market as far as pricing, go over our commercial property price forecast, where we see values going overall and by sector, and kind of how we make that forecast, get into our private market expected returns by sector, and kind of dive into our underwriting, and then lay out the public market opportunity, what we're seeing in REITs, what's interesting there. And if time permits, we can get in a little bit into fund flows and how that impacts commercial real estate. So what we've seen year to date, we have values down about 13% according to what we're seeing out there. And our commercial property price index is a little bit different than some of the others in that we aren't waiting for transactions to close. We try to be on top of it and out in front. And so we move values down to where they're being negotiated at this time. And so like last month, we moved prices down pretty widely across the board. And we've been doing that fairly aggressively, maybe sooner than some other data providers have. And we believe that doing that gives us a more accurate picture of where property prices actually are. And breaking that down to the sector level, you can see there's been a pretty wide discrepancy across sectors as far as what we've been seeing in value declines. There's been a little bit of a COVID reversal occurring where some of the winners, apartments, industrials, are down more than lodging, that never really fully recovered from COVID. Another thing we're seeing is lower cap rate sectors are being impacted a little bit more just due to the base effects of rising interest rates. And then moving on to how our commercial property price forecast, where we see values going, we look at two signals. The first is the signal from the bond market. And we underwrite, the commercial real estate expected returns. And traditionally, that expected return, there's a premium over corporate bond yields. And historically, it's been about 200 basis points. And as you can see, even with values going down this year, rates have come up significantly, and that spread is historically tight. And this next chart kind of shows that in a different way. It's just the spread, and you can see that the spread is historically tight to where it has been, indicating that there's likely further room for prices to continue to come down when you look at the bond signal. The next signal that we look at is the signal from the REIT market. So where are REITs trading relative to their asset value? And you can think of that as being a GAV premium or a GAV discount. When REITs are trading at a GAV premium, that means that they're trading above the value of the private market assets. And that's a bullish indicator for commercial real estate prices. And when they're trading at a discount, like they're trading at now, they're trading below the value of their assets. And that's a bearish signal. And that signal has been fairly predictive over the years. This chart shows the GAV premium and then property appreciation over the next 6 months. So it's lagged 6 months. And there's a pretty good correlation. There was a little bit of a disconnect between 2015 and 2018, where we had some false signals there. And but for the most part, it's been predictive. And the signal right now is a fairly strong signal to the downside. We're at a negative 16% GAV discount. And then when we put these two signals together, we get our commercial property price forecast. We're just weighting them 50-50. We're not trying to be too overly precise here. This signal is stronger and means more when it's plus or minus 10%. So if this were to come in at, -3 or -5, we'd say, okay, roughly flat, just because we don't have as much confidence in it when it's not strong. But when the signal is plus or minus 10%, that's when we have more confidence in the direction of property prices over the next 6 to 12 months. And then just at the sector level, getting into some property price forecasts at the sector level, these are the current GAV discounts or premiums at the sector level. And as you can see, there's some wide differences amongst the sectors. Apartment, life science, self-storage, those stand out as being fairly big discounts relative to what is normal and what is typical. The industrial sector also has been trading at large premiums for a while, and we've recently seen that slip into a discount. Even though we had earnings yesterday, Prologis and some other big REITs released their earnings, and fundamentals seem to be holding up fairly strong. However, there's some concern about 23 and 24. And that seems to be a common theme right now, as we're seeing on the ground, is that fundamentals right now appear to be strong in apartments and even for strip centers. However, as you get into 2023 and 2024, there's some clouds on the horizon, and the outlook doesn't look quite as good as far as fundamentals go. And so that kind of leaves us, what's been driving the decrease in values year to date. You can think of value decline as being numerator driven or denominator driven. So numerator driven, if you think of, okay, property price, your basic commercial real estate formula, value equals NOI divided by your cap rate. So your cap rate's your denominator. And when interest rates rise, that affects your denominator, brings your denominator up, decreasing your value. And when NOI goes down, that's a numerator driven value decline. We haven't seen any numerator impact yet. We could see that in 2023, 2024, but right now, all the value decline, if not most, if not all, has been driven by the denominator effect as interest rates are rising. So I just wanted to kind of get into that math a little bit there with people, because it is interesting that fundamentals remain fairly strong, but values are down nevertheless. And then kind of getting into that commercial property price forecast, where we marry the bond signal and the GAV signal, and you get a sector level conclusion. Now, these are not meant to be, down 19, down 16. It's meant to be more of a relative basis. You could say, okay, relative, all things equal, apartments are probably going to be more impacted going forward than manufactured homes or even industrial. And, life science is going to be more impacted than strip centers on a relative basis. So that's kind of how we're looking at it and how we're seeing things. We're not trying to give the impression of being overly precise, but on a relative basis, this is how we kind of see things shaking out when you marry those two signals. And then just want to touch on negative leverage. This is something that we wrote a report on and that is interesting. Negative leverage, so that's when your yield on your debt or your interest rate you're paying on your debt is higher than your cap rate that you're paying. Meaning that to have a positive return, you're really counting on NOI growth. That's how you're hitting your underwriting hurdles, is you're saying, hey, I might be paying more in debt than in my cap rate, but I'm underwriting, X amount of growth that's going to get me to the spot where I want to be in 5 to 7 years. And we're seeing an unprecedented level, not unprecedented, but we're seeing a high level of negative leverage that we haven't seen since 2007. And the amount of negative leverage varies by sector. Industrial currently has the highest, and then apartments kind of makes sense more for industrial, given that you have a lot of loss to lease. Current in place rents are lower than what the market is, and you can, as those renew, you can get, there's embedded growth in that. And so the industrial one, it looks huge, like, oh wow, over 200 basis points of negative leverage, but some of that is just because there's leases that will be rolling and you have that growth already baked in. So you're willing to pay a lower cap rate today on in-place NOI because the stabilized NOI is going to come in higher. And then this is probably the most important chart that we publish at Green Street. And I'll get into it, I'll break it down. But what this is our underwriting for expected returns in the private market by sector. And I'll kind of get into each of the different pieces and talk about them and how we build up to it. So the first thing we start with is the cap rate. That's your initial yield. And we modify that for CapEx. Green Street, kind of a fundamental tenet of our research is that we believe that CapEx is fundamentally mispriced, that public and private market participants don't fully underwrite the amount of CapEx that is needed to keep properties competitive. And so we underwrite a fairly high level of CapEx for office, 30% of NOI a year going to CapEx just to maintain, long-term growth of 1.7%. And so once you adjust the cap rate for an economic cap rate, you can think of this as being like your yield after CapEx. That's our starting point. And then we do a pretty basic DCF, something that you learned in Finance 101, to get to an IRR or adjusted return. But we layer in an intermediate growth. So that's this column right here. And you can kind of see that varies by sector. Growth is best in an intermediate term for single family rental, manufactured homes, towers, self-storage. And growth is looking a little weaker for office and data centers and malls. Some of that is structural, and some of that is cyclical, given the malls are more economically sensitive. We're having a little bit of a slowdown, and that's in our forecast. Data centers is an interesting one. If you guys ever, I don't know how many of you guys have spent time on that sector, but data centers has actually have negative NOI growth for a while, and being positive for the first time is interesting, just given what's been going on with the huge surge in the movement to the cloud. And then office, there's no surprise there. We've been seeing the work from home impact has been impacting our office fundamentals and our outlook for growth. And then the next column is our long-term growth. This is the most subjective part of our underwriting, and this is growth for years 6 into perpetuity. And we think of long-term growth a little bit different than others do. So we think of it as inflation plus or minus. And most sectors grow at a long-term growth rate that is less than inflation. And you're saying, hey, whoa, that's not what I'm seeing. But over the long term, we have lots of data from publicly traded REITs and from NCREIF that shows that for the given level of CapEx that we're underwriting, most property sectors in the long term, the growth rate is less than inflation. And you can see that over here for our long-term growth. Inflation is, we have it at 2.35% for year 6 into perpetuity. This inflation rate just comes from what's being priced into the bond market right now for years after year 6. And there's a few sectors like manufactured homes and towers and industrial where we have growth that is meaningfully more than inflation. And for most of the other sectors, it's either right around inflation or less than inflation. And then the last little bit is we have an adjustment for volatility. This is an important adjustment. We've done a lot of work on historical sensitivity to GDP change or economic conditions. And we kind of come to how it shakes out on a relative basis by sectors in this chart. You can see that some of the more non-traditional sectors like self-storage, manufactured housing, single-family rental are less volatile than the more traditional core sectors of mall, office, industrial. And that's reflected in these risk adjustments. So industrial, we make a negative adjustment for economic sensitivity. Lodging, we make a negative adjustment, whereas towers, we're giving them a positive adjustment, and manufactured homes a positive adjustment. And then this other column here, this is just it's mostly the risk of net zero. There's a couple other like technology related risk factors for towers, but for the most part, that's the movement to net zero and just the risk associated with that by sector. And so that builds us up to where things shake out on a relative basis between sectors. And as you can see, manufactured housing, we really like, it's at the very top. And surprisingly, malls, that's been at the bottom for a long time, and that's kind of creeped up as that cap rate has creeped up. There comes a certain point in time when you're getting such a high cap rate going in that it's even though your growth isn't great and your long-term outlook, growth is slower, you're getting a high net initial yield, which pushes you towards the top. Office is at the bottom, along with life science and data centers, and apartments is down there too right now. So that's where we're at in the private market. And now I kind of want to get into what we're seeing in the public market and the opportunity. Ideally, we believe that commercial real estate investors should have a dual mandate, meaning they can invest in the public market and the private market and use maybe different signals or differences in pricing to arbitrage the two. And you can see here that when REITs trade at an NAV discount, which they're trading at now, the returns of REITs versus Odyssey, and Odyssey is, for those of you who don't know, it's a NCREIF index. It's kind of like the private market benchmark that people use, even though it's not a great benchmark, but it's the best one we have. And so when you compare REIT returns versus Odyssey for the next 3 years, REITs significantly outperform. So the formula is when REITs are trading at a discount, investing in REITs is a way to add alpha over the long term, because as the left chart shows, over the long run, which is this side of the chart, REITs, return similar. REITs in public market and the private market have similar, long-term returns, but in the short term, they can differ a lot. Like we've seen this year, REITs are down 28%, and Odyssey, their appraisers have their values up 13% year to date. We think that number is suspect and inaccurate. However, there's obviously an opportunity here in the public market, and a lot of people are turned off by the volatility, but we see that volatility as an opportunity and not a threat. And then playing off that, this is the GAV discounts that I showed everyone earlier. these GAV discounts, they're historically wide and large. So as far as like, you can think of it as, has this ever occurred before? For self-storage and apartments and life science, I mean, we've never seen discounts this big. And the other sectors, it's, there's only been a couple times in the 25 years that we've covered some of these sectors that we've seen discounts like this. So that's something interesting and something that kind of puts into perspective the public market opportunity that we're seeing right now. And then this is just another way to show the public market opportunity that makes it's a little easier to translate for private market investors. People are used to talking cap rates, and it's easier to say, oh, like in the private market, I'm paying, there's a 4 handle on my cap rate that I'm paying, but in the public market, I could buy, a diversified portfolio of high quality assets with best in class management, and I'd pay, nearly a 6 cap for that. And there's other sectors, office, you can go buy it in the private market if you want, and you're paying a 6 cap, or in the public market, you're going to be paying you get a yield of nearly 9%. So that's interesting. And there's some big gaps. There's some sectors where they're trading kind of right on top of each other as far as cap rate goes. But this is another way to show it, and a way to kind of visualize the differences in how the public and private market are currently pricing real estate. And then, okay, like what sectors do we like in the public market? And how we build up to this chart is we take that private return that I showed you earlier, and we adjust it for how they're currently trading. That's that GAV premium I talked about. We make little modifications for G&A, external growth, some balance sheet, and just some other minor adjustments to get to our public market risk-adjusted expected return. So in the public market right now, we're liking self-storage, single-family rental, manufactured housing, and we're not liking data centers, net lease, and lodging. It's interesting, office in the private market is at the very bottom, but they're trading at such a large discount that they're kind of in the middle of pack in the public market. And the same goes for ground lease. This is kind of a funky sector. I don't love to talk about ground lease because it's only one company, and it's kind of a funky company, but ground lease was towards the very top of the private market sector allocation. And it's really just in the middle of the pack, kind of towards the bottom in the public market. So you can get some different signals on what sectors to buy in the public and the private market based on how they're trading. And so it looks like we have a little bit of time left before we open it up for questions. So I'll kind of get into capital flows. This is kind of an area that I focus on at Green Street. I produce a biannual report called the FlowTracker, where we track flows into the public and the private markets. And 2021 was a great year for capital flows. And when we look at net flows, I like to look at actual capital called, because you can kind of get a distorted signal when you look at fundraising, especially closed-end funds. You can raise a fund and you can sit on it for years and years and years before you have to deploy that capital. So looking at actual flows, capital that was called and put to work in commercial real estate, 2021 was an outstanding year. And we saw some of the effects of that in higher property prices. 2021, I think we had property prices up over 20%, which was the best year that we've had on record for property prices year over year. And part of what was driving some of that appreciation was the entrance of the non-traded REIT. These are private vehicles with the REIT label that have some sort of liquidity, that are kind of positioned for high net worth individuals, retail investors, the biggest of which is Blackstone's REIT, or BREIT. They've been raising a prodigious amount of capital. During 2021, they're raising over $2 billion a month. It's kind of slowed down a little bit this year, but they were raising a lot of money and putting a lot of money to work. And we saw that having an effect in the public and the private market. Blackstone, using some of this non-trade REIT money, privatized a couple REITs, namely American Campus Communities and PSB, Business Parks. And this is kind of an interesting thing that we're seeing happening right now, the non-trade REIT. And as far as capital raising and fund flows so far this year, we've seen some big fundraising. Blackstone and Brookfield both raised huge funds. Blackstone's fund was over 25 billion. That's a closed-end fund. They don't have to invest all of that right away, but it means that dry powder is at all-time highs and could be interesting. It means, what does that mean for private market pricing? It means that, hey, maybe the disconnect between the private market and the public market could continue or could be prolonged, given just the amount of capital waiting to be deployed in the private market. You don't see the same level of interest to deploy capital in the public market as far as this dry powder goes. The big dedicated REIT investors, so think of these as being big mutual funds or big groups that invest pension fund money into REITs. Their inflows have been negative for some time and kind of have flattened out over the last couple of years, but the private market is raising a lot of money, and that's kind of could be contributing to some of the dynamic that we're seeing. And then one thing that is interesting is the denominator effect. So pension funds, they typically have a target for real estate of where they want to be. And for a long time, they've been below that target. And that's been good for private market fundraising because they, are looking to deploy more and more capital into the private market, into real estate funds. However, when you have private market real estate values kind of holding steady, that was that NCREIF and Odyssey stat I pointed out before, they're up 12% year to date. And you have the other parts of your portfolio, bonds and equities, selling off, you begin to see the denominator effect where all of a sudden real estate becomes a larger and larger portion of these pension funds portfolio. And so they go from being below their target allocation to above their target allocation in a short amount of time. And that could impact fundraising going forward. It's something that we're watching, something that we're looking for. That kind of wraps up my prepared remarks. We'll have a good amount of time for Q&A here. But I wanted to, if any of you guys have questions, want to reach out to me directly, I'd be happy to spend some time. I always love to hear from BYU alumni or people who are just interested in what we're doing. So please reach out to me. I'd love to hear from you. And with that, we'll open it up for Q&A.
Great. Jared, fabulous job. Thank you so much for that. Go ahead, those of you who are on the call, send in any questions that you may have while those come in. I've got some for you. Go back if you can, Jared, and let's just go up to the capital flows one. That one. What kind of cross-border capital flows do you monitor that at all? Because it's been so interesting to see the strength of the dollar, and I'm just curious if that's impacting the capital flows into this area.
Yeah, it's something that it's actually an active area for research for us right now. So it's something that we're looking at. We the cost to hedge currencies has gone up significantly, and that should impact flows into US real estate, shouldn't have a negative impact. However, it's hard to argue that the US economy is, on a relative basis compared to Europe or other parts of Asia, very strong. And when we actually released, we have this product, it's called our Global Property Allocator, where we kind of take that framework that I laid out before and we overlay it with some other signals and get, okay, where's the best expected return on real estate And the US still screens very, very well relative to Europe. So that's kind of where we're at. I don't have a great answer for you on that, but
So is that a product that you're working on, kind of a cross-border capital flows report or some sort of measure as well? That would be very interesting, I believe.
if we can get the data, I think we'd love to do that. We're having a little bit of an issue with the data, but it's an interest and it's an active area of research, something that we're looking for.
Okay, great. Okay, let's see if our questions are. We can, let's see. Are you open to sharing the slides? This presentation is open and is being recorded and is on for anyone who's interested. They just go to realestate.byu.edu and you should be able to see these. Let's go to here. We've got a question in comparison to 2021. Where do you expect 2022 in equity capital flows?
Yeah, I think it's going to be significantly lower. We're kind of the 2022 is delayed a little bit because this is actual capital called and distributed, but I don't think it will be negative, but it will be significantly smaller just because transaction volume has slowed down. And so there's less money being put to work as the bid-ask spread has widened. So you can think of that as being what buyers are willing to pay and what sellers are willing to sell their properties for is wide, and that's slowed down transaction volume. So not as much money is being put to work, therefore not as much money is being called, therefore the net flows is lower.
Okay, great. Go up if you can on your slides. Let's just go back while we some other questions come in. I've got some. Go to the next one. Yeah, this is very interesting to me with regards to NCREIF Odyssey funds versus REITs. Do you think that a fair amount of this differential is occurring just because of the lagged effect that we get in the NCREIF data?
Yes, this is a prime example of the appraisal lag. So, Green Street, we're taking our values up aggressively last year. We saw, like I mentioned, we were year over year up 20%. Odyssey was not up as much last year, and some of that has bled into this year, leading year-to-date total returns for Odyssey to look very different than REITs.
Yeah, go down if you can one, and let's back. Yes, let's talk about office. This is an intriguing area right now, trying to figure out this structural shift that may be occurring in remote and hybrid. What are you all seeing in that regard in your research?
Yeah, so we're seeing a bifurcation between the best of the best office properties and the rest. And the best of the best office properties, which the REITs own a lot of actually, are seeing, strong tenant demand. They're seeing, positive releasing spreads. However, for the rest of the office market, the outlook is much less cheery. And as far as the impact from work from home, we're estimating that the work from home impact will be about 15% on demand. So what demand would have been in a normal situation is now reduced 15% from the impact of work from home.
Interesting. So with regards to gateway cities or CBD versus, very high end, you're saying that's.
Yeah. So we're seeing high end CBD office, looking better on a relative basis, but also the Sunbelt's been really strong as far as apartments and office. There's been a lot of growth, a lot of activity, a lot of vibrancy there. San Francisco, New York City, they haven't really bounced back as much. San Francisco especially. So we're seeing a lot of strength in the Sunbelt on a relative basis.
Okay, great. Okay, we have a question that just came in. I'll just read it here. I've heard that the private market lags the public market by about 18 months. Even though the GAV discounts are large, are you worried about the private markets diminishing in the near term?
Yeah, I kind of think that's what this slide right here. That's what this market shows. It shows that, hey, we think over the next 6 to 12 months, private market prices are going down, given the signal from the public market. So yeah, I think the next movement in our cap rates is likely up, meaning values down.
Right. Okay, let's go back to let's, if we can, maybe go to let me advance here. Talk a little bit about life science. I noticed that in some of the slides, it looked like life science was not performing very well, and yet what's the thinking there? What's happening?
Yeah, so life science was a hot sector in 2020, 2021. You know, we had mRNA vaccines and we were unleashing this new unprecedented amount of investment and excitement for life science. And as the, VC and the venture capital funding has been drying up and interest rates are rising, there's been some difficulty among some of the tenants of life science. And the outlook going forward as far as VC fundraising for more speculative life science type products is lower than it was at the start of the year. And so that's been driving some concerns for like the numerator of life science. The other kind of headwind for life science is all that excitement generated a good amount of supply and competition coming online in the big life science markets, things like your Cambridge, your San Diego's, your South Bay, San Francisco. So those markets are seeing an increased amount of supply. At the same time, their tenants are having a less favorable fundraising environment. And so Alexandria, ARE, that's the biggest life science focused REIT. They're currently trading at an unprecedented discount to their gross asset values.
Interesting. I see on the chart, of course, you've explained a little bit, data centers, apartments, life science, those were all kind of, I think, bid up, right? They were kind of in a premium environment, maybe overpriced. Single family rental surprised me.
Yeah, so that's one that's interesting. Single family rentals, kind of, if you go back to this chart, I mean, the growth outlook is still really strong.
Right.
The growth outlook is strong. It screens well. It screens well, fairly well, in the middle of the pack on our private market expected return index. And I think the issue here is the REITs are trading at a GAV discount as the public market is pricing in home price declines. And we're kind of seeing that happening for single family rental and why they've been struggling in the public market, and kind of the signal going forward for the private market is strong on the negative side. Even though fundamentals are strong, I think people are worried about home prices declining. So
this is, talked about that a little bit. If you have in an inflationary period and you would think that rents on homes would be going up, ceteris paribus, everything equal as far as demand and supply. And yet the interest rates are going up, of course, for owner occupants. So you could see that sector having pressure downward. And I guess that just translates what you're thinking about the single family rental market.
Yeah, like we feel like the fundamentals are strong for single family rental. I personally like the sector in the public market. I believe it's at the very top, if I remember correctly, at the very top or right around the top in the public market. We like it in the public market, and fundamentals are strong. I mean, I know us personally, like we were planning to buy a house. We're probably not buying a house in the next 6 months. And so we're going to be renting a little bit longer. And there's probably other people in the same boat as us. So fundamentals, I think, look good for the single family rental sector, and they're on sale on the public market right now.
Okay, great. Okay, we have a couple of questions that just came in. Are you worried about projects that are currently being built with high costs and now high interest rates?
Yeah, there's some sectors that we're a little bit concerned about supply. I think industrial is one of those sectors. For so long, they haven't been able to build fast enough to keep up with demand. And now we're seeing a little bit of a pullback. Some of the REITs in their earnings calls yesterdays were saying, hey, like we're a little bit concerned about 2023, 2024, as there's this, I think there's over 100 million square feet of industrial space hitting the market, if my memory recalls correctly. So I think that's one sector that we're a little bit concerned about supply. And then just in the Sun Belt apartments, some supply pipelines are high. They're not that high on a historical basis, but relative to 2019 and where we were in the recent memory, they're a little bit elevated. And there are some concerns for market participants in those markets about Sun Belt apartment supply.
Yeah. Okay, thank you. Here's another one. This person wrote, I'm concerned about what the future looks like when we move from construction to permanent debt, meaning, rolling it over into a long term. Would love to hear your thoughts.
Yeah, that's a concern. That's messy, right? You have short-term bridge financing. You thought you're going to roll it over at a much lower interest rate than you're paying today. For the REITs, that's not a huge issue, and it's not something that we focus a ton on, because a lot of our REITs and the companies that we cover, they fund it off balance sheet with unsecured public debt offerings. So we don't do a ton of construction loans, but in the private market, it's definitely a potential pain point. Another potential pain point, there's some markets where there's a high amount of floating rate debt issued. You think of some Sunbelt apartments, and as those floating rates come up, and maybe there's a balloon payment associated with that. That's something that we're watching, but not something that I personally have a ton of direct experience and can talk to extensively. But it's definitely a point of concern.
Great, thank you. I noticed we've got one question regarding healthcare. And what are your thoughts about that sector? You see that it's pretty high on the list here on this slide that you have with regards to expected return.
Mm-hmm. Yeah, healthcare is a little bit of a funky sector, and it's a one that's honestly hard for us to cover. And the reason why is because there's not really a pure play. Like healthcare is a lot of different things all put into a healthcare label, right? You have senior housing or that you operate, you have triple net lease senior housing, you have SNFs, you have hospitals, you have medical office buildings, and you also have some life science in there too. And the three big REITs, they all kind of own a mix of everything. And so the signals get a little bit mixed. But healthcare, I think one of the things that people like about healthcare is it's more defensive. So going into economic uncertainty, healthcare is more defensive. As you can see, we have a positive adjustment here for healthcare as far as volatility goes. And then also the going in yield on some sectors is fairly high for in the healthcare space. And I think that pushes it towards the top. But like I said, it's hard to talk about healthcare as a whole because there's so many different parts and different moving pieces to it. I know one of the most topical for private market participants is senior housing. Senior housing has been in kind of a tough spot. You saw occupancy drop significantly. It's rebounded a little bit during the pandemic, but operating costs have really been putting pressure on senior housing operators, and you've seen margins decrease, and it's been tough for them. And we're not entirely sure how that's gonna play out. And then the other thing that senior housing is battling is you're battling technological improvements that decrease the number of people that want to use senior housing. They can stay in their own house longer, and they're dealing with some headwinds there.
Okay, great, thank you. Roll up if you can right to the very first slide, and just love your thoughts more about the index, the price, the CPPI.
Mm-hmm.
Tell us a little bit, educate us a little bit about how that index is constructed. You mentioned that we are very familiar, of course, with the housing Case-Shiller repeat sales index. We some commercial transaction-based indices. We see NACREIF, appraisal-based index. Here's something different. Help
Right.
understand
Right.
what it is.
Right. So it's a weighted average of the different property sectors. Different property sectors. So it's a weighted average of what we're seeing in this chart right here. And it is not transaction based. It's not appraisal based. It's where we're seeing deals being negotiated in the private market right now. So it's almost like we're skating a little bit to where the puck is going. We use the public market to inform a little bit, but we're always trying to have actual data points on the ground for, hey, we're seeing apartments being discussed at X cap rate versus 6 months ago was, at a lower Y cap rate. And we're trying to move to that so that we are moving values appropriately, because these private market prices, they impact our REIT GAV premiums. So when we move our private market cap rates, say we move apartment cap rates up and they were trading at a large discount, all of a sudden that discount shrinks because now their private market values have gone down. And so we try to stay on top of this because if we have the wrong number in there, it distorts our public market signals.
Yeah. Okay. Excellent. Jared, this has been absolutely fabulous. Very informative. Our time is about gone. As you know, I usually like to end by inviting the guests to share a thought or two with regards to the students who are on the call. We have students that are going to be entering the workforce this coming year, and you're out there a little bit in front of them, and you're doing great. And give us a thought or two. What would you tell them as they prepare? What could they do, or any nugget of wisdom you'd like to share with them?
I think the biggest thing is persistence. I remember it took me actually a long time to land my job out of college. So I landed with Green Street, but I didn't have my offer with Green Street until end of March, my senior year. And so obviously I'm really happy with where I landed. I'm happy with how it goes, but there was some persistence there. And there was some, you have troughs, you have valleys, you have peaks. And I just encourage you all to be persistent, keep going, keep striving, keep reaching out, build your network, have a good pipeline, and stay positive, because, it sounds cheesy, but it's true. Attitude does determine your altitude.
Great. Super. Jared, thanks again. Sure appreciate it, and look forward to seeing you on campus someday.
I hope to be back.
Well, thank you. And for all who are on the call, thanks for joining us. And we welcome you back on November 17th, where we'll get into the weeds and discuss the Utah housing market. Have a wonderful day and take care.